Well, good afternoon and welcome. Thank you for joining us today for the Three Corners Capital second quarter investment webinar. My name is Steve Fortin, and along with my partner Chris Flores, we're very pleased to host today's investment update with Jack Manley of JP Morgan. Jack serves as the Executive Director and Global Market Strategist at JP Morgan Asset Management. And you may remember Jack, he was also a presenter during our investment forum earlier this year in February. So welcome back to you, Jack. Great to have you again with us today.
Thank you.
And, in our work, as you know, we utilize a variety of research and investment strategies from, many different industry players. And JP Morgan is definitely one of the leading firms that we rely on in that endeavor. So we greatly appreciate their partnership and willingness to share insights today with our clients and friends. So before I turn it over to Jack, just a couple housekeeping items. This webinar is being recorded, but we are unable to take live questions from the audience. However, if you have any questions after this session, please reach out to us. We're happy to discuss things with you. So welcome, Jack. I know your presentation is titled Investing Through the Noise. And, we've certainly had a tremendous amount of noise and back and forth whipsaw-like action over the past few months. And this can make it, very difficult for investors to kind of glean through there and understand the facts and really what is important for them and their portfolios. So we're looking forward to hearing your thoughts. Go ahead and take it away. Thanks.
All right. Well, thank you very much, Steve, and thanks everybody for taking some time to dial in today. I mean, I think you hit the nail on the head with that introduction there. It is awfully noisy right now for us as investors. And, when I'm trying to figure out what it is exactly that I need to be paying attention to if I want to have a view on markets. In other words, if I'm trying to hear kind of the signal through all the noise that's out there, I found that it's been very helpful to sort of set up a checklist almost. Like, what are the things that I need to know or at least have an opinion on if I want to have an opinion or view on investing? One of those things that I have to have a view on, one of the boxes that I have to check is I got to have a view on interest rates. And when I say interest rates, I really mean the Federal Reserve and monetary policy. And I need to know what's going on with interest rates because interest rates are, in effect, the cost of money, right? And that's going to matter a whole lot. It's going to matter from an economic perspective, certainly. It's also going to help to inform coupon, duration, valuations, earnings expectations, all the things that kind of go into those assets that you hold in your portfolio. But if I want to check that box and have a view on rates, well, I got to check a box before that, which is to have a view on the economy. Because when the Fed gets together, like it will be doing actually later today, and it issues a statement, puts out a press conference, does something with rates, it's doing that in response to underlying macroeconomic conditions. The Fed pays attention to GDP growth, recession risk. It also, of course, pays attention to employment numbers, to inflation numbers. And so, hey, we have to have a view on this stuff too if we want to be able to check that second box to have a view on rates, which will ultimately allow us to get to that view on markets. And that's kind of the rough framework, agenda, whatever you want to call it, for any kind of discussion that I have about investing and for today's discussion too. And I have to admit, right, that when it comes to checking that first box to having a view on the economy, that's gotten a lot harder in these past few months because so much of the noise that we're dealing with is emanating from Washington. It's policy related, and those policies certainly have the ability to directly influence the trajectory of the economy. So what I found to be helpful given that is to kind of set up a baseline expectation. What would this economy have done this year on its own if it had been sort of left to its own devices? And then figure out how policy may influence all these different potential outcomes for growth, for employment and inflation. And it doesn't necessarily solve for an absolute answer. Nobody really knows what's going on with the economy at the moment, but it does at least help you to put some kind of guardrails around the conversation. So with that in mind and in that spirit, let's turn to the next page here and start by talking a bit about GDP growth. And if you saw, you might have last week, we got our first official view of first quarter GDP growth. It was a modest contraction, minus 0.3%, the first contraction that we've all actually seen from an economic perspective since the first quarter of 2022. But let's put aside that first quarter print, that negative print for a moment, and talk a little bit about the trend that we've seen in the economy over the past several years. You can see, right, that 2024, like 2023, where it was a pretty good year for the economy. You know, coming into this year, into 2025, there was a lot of momentum. There was a lot of strength. We had two back-to-back years of above-trend economic growth, two back-to-back years where growth actually managed to defy expectations. And what was leading to this kind of unexpected resilience, I guess I'd say, is that light blue thing that we highlight on this page, which is consumption. You know, it's people like us going out and spending. We are the largest part of this economy. You can see that in the table. We're 70% of GDP. We are also the most reliable, most dependable part of this economy. And you can actually see that in the chart. This chart is real GDP growth on a quarterly basis. And I think it's really cool. The only bar on this page that is consistently positive, the only one that every quarter is north of zero, is that light blue bar, is consumption. And I think it's really important to point out that even with that disappointing first quarter GDP print, we can say once again that the consumer has been able to hang in there. Just remarkable resilience from a consumption perspective. And so if we're trying to figure out where this economy is going from here, it is worth understanding what's been driving that unexpected resilience in the consumer. And if you look at the next page here, I think a lot of it actually has to do with what's going on with the labor force. And for a very long time, and we got evidence of this as recent as last week, we've been living through a very tight labor market. And when I say a tight labor market, I mean very strong payroll gains. The most recent read was almost 180,000 jobs added for the month of April. I mean, an unemployment rate that is floating at or near all-time lows. I mean, wage growth that for many years now has been beating inflation month in, month out. All of this extremely supportive of consumption, because coming into this year, we are dealing with a laundry list of problems as consumers: higher prices, higher rates, geopolitics, our own kind of domestic uncertainty. But at the beginning of this year, almost every American that wants a job has one. And their friends have jobs, and their families have jobs, and they're not particularly worried about losing their jobs, and they're relatively satisfied with what they're getting paid. And so they have this confidence to swipe the credit card, knowing that in a week or two or four, a new paycheck's going to hit the bank account and make everything okay. So to have a view on where consumption is going this year, some of this has to, I think, have to do with what's going on with labor. And when I think about what's going on with the labor market, the most interesting thing that I can highlight is that we are facing in this country a chronic shortage of laborers. We're just running out of workers. And a lot of that has to do with the fact that our demographics here are abysmal and they are working against us. We got an aging population. The baby boom is getting older. It's slowly rolling out of the workforce, retiring. We have a declining birth rate. Americans just are not having kids at the rate that they used to. And in fact, because of these two things, the Census Bureau tells us that within a decade, by 2035, deaths will outstrip births in the United States, and our native-born population is going to start to shrink. That is pretty remarkable. And it's awfully hard to grow an economy against a shrinking supply of labor. And so if you look at the chart on the top right side of this page, you will see that in the last 4 years, immigration has played a very significant role in turbocharging the growth of the labor supply. We've needed that immigration to help to make up for the deficit that we would have otherwise been running because of these declining demographics. Now, immigration is, of course, a hot topic in Washington right now, but let's be serious. Immigration has been a hot topic in Washington for decades. It is fickle. It constantly is. It's highly cyclical. It ebbs and flows. We cannot count on it to sort of bail us out in the face of these weakening or worsening demographics. which leads again back to that initial point, which is that our labor force just isn't growing as quickly as we need it to. We are facing this structural supply constraint of labor. And what that means to me, going through this year, barring some sort of massive shock, we likely have continued to see further tightness in the labor market, right? An unemployment rate that stayed low, job gains that stayed robust, wage growth that stayed beating inflation, all of this continuing to support the consumer. And so when I think about the kind of baseline expectation for GDP growth in 2025, right? Like what would we have been doing? What our position would have been at the beginning of the year? I think we can pretty confidently say that this economy was set to avoid a recession, almost certainly, but also was set to maybe even post another year of above trend growth. That's the baseline. That's where we were coming into this year. You look at the next page here, the other side of this macro stuff is, of course, inflation. And this page from our Guide to the Markets, I think, does a great job of kind of charting out not just what this inflationary journey has looked like over these last several years. This is headline CPI inflation, one of the numbers that you'll see quoted, on CNBC or in the Wall Street Journal or whatever it happens to be. But it also shows how the stuff that's been driving inflation has changed over time. And you got to understand how it's changed over time if you're trying to have a view on where it's going from here. You look at that number in the sort of middle right side of this page, we annotated June of 2022. That is the hottest inflation got post-COVID, the hottest inflation got since 1981 at 9.1%. But think about what was going on around the world in June of 2022. Russia had just invaded Ukraine, two very large producers, exporters of commodity products, food, fuel. We don't know how we're going to get a hold of this stuff, and prices spike as a result. In June of 2022, we are dealing with, I would say, a pretty nasty kind of COVID hangover. Like we've reopened, certainly. We're back at school, we're back at work. Most of the world has reopened. We're back to doing normal stuff for the most part. But there is one big exception to that story, which is China. And in 2022, China still thinks it can beat COVID. China still has a zero COVID policy, and that's a problem because China makes a lot of stuff and COVID is really contagious. So when a case inevitably breaks out on the floor of a Chinese industrial facility, well, then that team gets quarantined, the belt or the plant gets shut down, and all of a sudden it becomes harder to find that stuff that China makes. And so prices spike as a result. Now you look at that 9.1% and you'll see that the green bar, which is energy, or the purple bar, which is groceries, the orange bar, goods, account for like 60 to 70% of all of that inflation that we had back then. Now you fast forward to where we are today, most recent read 2.4%. It's less than a third of where we were back then when things were really out of control. But way more interestingly, those green, purple, and orange bars that were like integral drivers of the inflationary, runaway inflationary narrative in 2022, they're so insignificant they barely even show up on the page. We're not looking at energy or grocery costs driving inflation. It's not goods costs driving inflation just yet. What's driving inflation right now is spending on shelter, spending on dining, recreation, other services. I call it fun. And at the beginning of the year, neither one of these components looked really set to give up a whole lot. And so when I think about the baseline expectation for inflation, I would say kind of more of what we've been seeing, right? Continuing to kind of bounce around between 2.5% and 3%, sort of stalling out on progress, but settling into a level that all things considered isn't so bad. And I think you take that 2.5% to 3% inflation outlook, you line it up with this baseline expectation for GDP growth to remain somewhat strong, for the unemployment rate to remain somewhat low. And you are looking at, in the beginning of this year, a real position of strength, right? A lot of evidence of a lot of warmth in this economy. And then you can start to have a conversation about policy. And, trade and tariffs, that's top of mind right now because that's what's right in front of us. But I think it's important to remember that the administration and the president in particular ran on making significant shifts to four big policy buckets. Trade is one, but there's also the regulatory environment, there's immigration policy, there's fiscal policy, meaning spending and taxation. So even when the trade conversations die down, there will be other major changes to policy that will influence this narrative. And B, nobody knows how these policy changes will individually impact the economy or collectively impact the economy. We are only 100 and so days into this administration. We have almost 2 years until the next midterms. We have, or about a year and a half until the next midterms. We have 3.5 years until the presidential election. This is an eternity in Washington. Anything can happen. And it is important to remember that you can take any one of those potential policy changes and look at it and say, this could cause a lot of problems for the economy, or it could end up being quite beneficial for the economy. And it's difficult, I know, to view things like that. And it's increasingly difficult because of how politicized and tribal the world's become. And it depends, what station you tune into in the morning. Either you think the world's falling apart or things have never been better. It's important to not see things in this binary and to assess kind of the gray area. Even tariffs, as an example, classically speaking, are inflationary, of course, because you're paying more for goods. And they're also bad for growth, because if you're paying more for goods, but you're not making more money, well, then the economy slows down. On the other hand, though, tariffs are, at least in theory, a kind of blunt force instrument used to push forward policy change. And what if the 17-18% tariffs that India had levied on the United States before the trade war began were lowered in response to reciprocal tariffs? Then we lower our tariffs. And now, at the end of the trade war, the barriers to trade are actually lower than they were when it started, not higher. And U.S. exports become more competitive. And all of a sudden, tariffs are long-term good for growth. I'm not saying it's going to happen, but it is possible. It's not a crazy way to think about things. And I just encourage everybody when they're assessing all these different potential policy changes to not be tempted into saying, good, bad, yes, no, but rather to acknowledge that there's a lot of nuance. The unfortunate side effect of that nuance is that it means that nobody knows what's going to happen with this economy this year. It could be supercharged, it could be in a recession, it could be anything in between. It's really hard to know. But what we do know is that we came into this year in a position of strength, which I think should give all of us a little bit of comfort, at least, in where things might be going from here.
Hey,
So,
hey, Jack,
yes.
Sorry, Steve, as we, think about the last couple slides that you've talked on labor force and inflation, curious your opinion, when you think about manufacturing, for example, and an emphasis on growing manufacturing or bringing manufacturing back in the United States, a lot of that is advanced manufacturing. You'll need someone with a degree to, operate robotics, et cetera. So on one hand, people may not be filling those roles, and maybe that's one way to offset, lack of, growth in the labor force. And then there's, on the other hand, there was a Wall Street Journal article today about, high schoolers, juniors in high school being recruited for skilled trades and being able to make really good money right out of high school. And there's a gap there. But both of those can also kind of have inflationary pressures. On one hand, if we can be more efficient in manufacturing, maybe that can help price. But on the other hand, if we don't have enough labor force for the skilled positions that impact things like our shelter, that could keep costs elevated, in some areas. I'm just curious, as you think about those different dynamics, how that might impact your thinking.
Yeah, I mean, I think you do a good job of illustrating, Chris, how many different ways things can go, right? Based off of all these different underlying dynamics. When you're talking about kids getting recruited out of high school into high-paying sort of trade jobs, it's very encouraging, but it's part of, I think, a broader cultural shift that needs to happen in this country, where for a very long time we have told children that if they don't go to college, they're stupid. And that's not necessarily true, right? I mean, there are plenty of reasons to not get an advanced degree. You can make very, very good money with a trade that doesn't require an $80,000 a year education. It's a long time away, I think, before we fully make that shift, but it is a part of what you're discussing here. Another part of what you're discussing here, I think, has to do, to your point, with robotics, or of course artificial intelligence, right? That's another thing that's been coming up a whole lot. And it is not a coincidence that in the first 100 days, the administration launched I think it was a joint venture with SoftBank, like $500 billion to build out America's artificial intelligence infrastructure. And there is sort of a silver bullet in here if we manage to figure things out where you can, sort of domicile manufacturing activity here, which would otherwise be prohibitively expensive because of labor costs. And instead of hiring all those people to build all these things, you just get more robots and more artificial intelligence to make most of the decisions and make most of the products. So then, manufacturing is here, but it isn't necessarily inflationary. The one last thing that you mentioned, and this is where things do get a little tricky, is that sort of supply of labor, and how you get around some of these bottlenecks. Illegal immigration is a big issue for this administration. It's something they're trying to push back on quite a bit. But all the data suggests, and I'm not saying good or bad, but just all the data suggests that there is a shadow workforce out there that isn't necessarily captured in the numbers, that is here without proper documentation, that is here illegally, but is instrumental in very specific pockets of the economy, like construction, like agriculture, like back of house staff at restaurants, and those jobs in part can be replaced by machines, I suppose, but it's going to be very hard to replace them entirely, especially with labor that might cost twice as much. So that side of things might be a little bit inflationary. It might counter some of the deflationary tendencies that we see through the broader adoption of artificial intelligence, automation, how that makes us more efficient. But which one of these two forces kind of wins out? Does it ultimately end up being inflationary or deflationary? I think we're years away from figuring that out at the moment, at least. It's a good question. And for the sake of time, let's move forward one more page, because there really is just one more thing that we actually need to discuss, right? If we're trying to have that view on markets, which is what's the Fed going to do given all this? And the short answer is nobody knows, right? Which is, again, kind of the theme of today's talk. Nobody really knows how policy is going to be implemented. So nobody really knows how the economy will evolve. So nobody really knows what the Fed's going to do. And I'm pretty sure today the Fed is not going to do anything with interest rates. That seems to be more or less the consensus here. But today is not what's important. It is the longer term view. And the Fed not too long ago actually gave us a glimpse at how it's thinking about managing monetary policy, because the Fed, unlike almost any other central bank out there, does this thing on a quarterly basis where they put out something called the Summary of Economic Projections, the SEP. And in the most recent SEP, which was published back in March, so about a month and a half ago, the Fed took their growth expectations for this year and revised them lower. They took their inflation expectations for this year and revised them higher. And the Fed didn't say it, and Jay Powell didn't say it. They didn't say stagflation. But if you take growth and you make it worse, and you take inflation and you make it warmer, well, that's ultimately where you're going. And that is kind of the worst case scenario macro outlook, because there's no obvious way to manage monetary policy. But the good news is that despite making those revisions, the Fed still confirmed for us through their dot plot, which we show in dark blue on the right-hand side of this page, that they're planning on cutting rates. They told us 50 basis points this year, 50 next year, 25 the year after that. I'm not exactly convinced on those numbers, but the Fed told us that they are biased towards lowering interest rates. Super important, because what that tells me is that when the Fed is looking at its kind of dual mandate, maximum employment, price stability, health of the labor market and the consumer versus inflation, the Fed is willing to prioritize the consumer, prioritize the labor market, even if it means a little bit of inflation that it would have otherwise not liked. What we don't know, though, is what that cutting cycle is going to look like, because the Fed's on pause right now. When's it going to start again? And when it starts again, how many cuts are there going to be? And how big will those cuts be? How frequent will the cuts be? How long will the cuts last? What is the ultimate level that the Fed's trying to get down to? Nobody knows the answer to those questions. The Fed itself doesn't even know the answer to those questions. The Fed can't have a view on what interest rates are going to look like 2-3 years from now when it doesn't know what's going to happen tomorrow or next week. And so the other thing that we show on the right-hand side of this page is that green line, which represents what the market thinks is actually going to happen. And you'll see, first of all, that the green line and the blue line are not touching, right? The market and the Fed are not on the same page. And way more interestingly, if you look at that light gray shaded area, that's everywhere that green line has been since the start of the year. Rate expectations have been whipsawing since December 31st because people are trying to wrap their heads around what's going on with the economy, how policy is going to influence it. And as long as there is uncertainty with policy, and there will be, because remember, even when we're done with trade, we're on to something else. That means there will be uncertainty for data, which means there will be uncertainty for interest rates, which means that unfortunately, I think we're going to be looking at more volatility this year. And so I think when we approach this as investors, the key I would say is to, not avoid risk, but to be cautious in that risk taking, right? Lean on fixed income to be that ballast to protect you in the event of a recession. Own high quality equities, big companies that are going to be recession proof. There are ways to play this story where you can be a little bit defensive while still leaning into risk, still leaning into markets. But a lot of it is just going to come back down to acknowledging and accepting that this will continue to be a bumpy ride, and that now more than ever, it is important to work with financial professionals, to stay the course, to keep your nose down, because we're going to come out of this at some point on the other side, and things will be just fine, I promise. And so with that, Steve, I'll pass things back over to you.
Yeah, well said, Jack. We're almost running out of time, but just wanted to ask one quick question, about, there's been a lot of focus on our Fed, but other central banks around the world have been cutting rates. And so how positive, how do you see that playing out going forward in terms of influencing the Fed and so forth?
I would say it's a great question, Steve. I would say other central banks care a lot more about what the Fed does than the Fed cares about what other central banks do. And that's because the dollar right now is extremely strong, even with some of the downward pressure we've seen over the past few months. And if there is a gap between where the Fed keeps rates and where everybody else keeps rates, that gap is generally speaking dollar positive. It attracts foreign investors into our assets, into our treasuries in particular. Those are priced in dollars. It pushes the dollar strength up. Now, trade policy in particular has the ability to really disrupt the global economy if things kind of go off the rails, and they might. Nobody really knows. Again, like, it could all work out great. It might not work out so great. If the global economy ends up in trouble, I think the U.S. is still likely going to be at the top of that dog pile. We're still going to be kind of the best house in a bad neighborhood, so to speak, which means that other central banks like the European Central Bank or the Bank of England or the Bank of Canada, they will likely be forced to cut more than we will, which will allow, again, the dollar to remain somewhat strong, and will fortify America's purchasing power. So that's one kind of release valve in all this to consider.
All right, great stuff, Jack. Well, in the interest of time, we're just at 12:30. I want to thank everyone, our clients and friends, for attending. I want to thank Jack. Your insights and thoughts have been very helpful, and we're so appreciative that you can be with us today. If anybody has any questions or concerns or issues, how this affects your portfolio and your financial planning, please reach out to us anytime. We're happy to help you, and hope everyone has a great day. Thanks again.
Thanks, everyone.